I'm Charlotte McLeod with the Investing News Network, and here today with me is Frank Holmes, CEO and CIO at US Global Investors. Thank you so much for joining me online today. Great to see you as always.
It's great to be with you, Charlotte, from my home.
Yes, from your home. Great to see you. We have a lot to cover today, but where I thought we would start is with last week's US Federal Reserve meeting. I wanted to ask you just briefly about your takeaways because I know that that was kind of a much anticipated event for market participants.
Well, it's a big issue on this inflation. And in August of 2020, I did a short 2-minute video on fake CPI numbers and said, get ready for big inflation. All the money printing, all the free checks that were going out, and there were some were needed, but some were excessive, many. And so what that does, that fiat money, it creates a big binge of inflation. So during COVID, everyone was binge eating potato chips and watching Netflix. And now that binge is catching up with inflation, and we have binge travel where people don't care about prices. So it's really interesting to see this event. But inflation was greatly understated. I recommend it many times. Go and borrow if you can borrow for a cheap mortgage. Do it now. Get a car loan for 2.5%. Get it, because used cars were up 25%. The cost for anything has just gone up dramatically. I believe that still inflation now, if you use the 1980 CPI indicator, inflation's at 15%. It's not at the 8-9%. So borrowing, even at these rates, look attractive, but the market is anticipating that they cannot raise it too far. We are in an election year, gubernatorial elections this year in the US. Biden has got to try to get back Congress. He doesn't control Congress. He controls Congress, but not the Senate. So the ability to have political power, you need to control both. And so we're seeing this sort of turmoil and the fear, but people are still binging. It's interesting to see that the travel, luxury goods. I just got sticker shock this weekend looking at what does it cost. And I have a luxury fund also. The price tags on buying Gucci or a Prada dress, a simple white dress, it's only $1,000. I mean, and there's a lineup to get in. So it's sort of that sticker shock hasn't really hit, except for the stock market, it has hit because there's a big trade-off of dividend yields versus a 10-year government bond. And all the quant funds do this recalibration. So they're selling down, selling down, selling down, and they're selling down anyone that doesn't have free cash flow. So all those non-free cash flow stocks are really getting hurt, except for a lot of the gold stocks are doing well, Charlotte. 60% of the gold producers have free cash flow. Last year, they said gold was down, but it was only 2 periods if you look at the beginning of the year, the end of the year, but the average price for gold miners was up almost 5%. So now we go this year and gold is actually doing exceptionally well. So you want to take a look at this special word. If they're not paying dividends, then they have to have free cash flow.
Okay, yeah, and let's talk a little bit more about gold and its reaction to last week's Fed news. We have seen it move down. Does that make sense to you in terms of price action? Because, we do often hear that gold doesn't do as well when rates increase, but at the same time, it's a really popular hedge against inflation. And we know that the Fed, despite its efforts, is not going to be reining in inflation anytime soon.
I think it's just still, buy the dip and hold on for dear life, as the crypto kids say, a HODL. But I think you got to buy the dip because these companies are doing so well, and gold demand, physical demand, is at a huge record level. If you look at the past quarter compared to the previous year, it's much stronger between September and December. The January to March was a much bigger offtake of gold bullion and gold jewelry. This is usually a precursor to rising gold markets.
Right. And I want to talk a little bit about Bitcoin as well, because I know you are an expert on that market.
I have to change my hat. I'm a man of many hats here. So let's go here to the high blockchain hat.
Perfect. Now we're ready to talk about Bitcoin. So it's making headlines this week for falling 50% from its high in 2021. In your opinion, what do we have going on there?
Well, it actually peaked last year when Elon Musk came out and said there's too much carbon being used by one of the crypto mining companies was very pro using coal. And that was really the peak that happened last April. And we can see that in HIVE was $7. It's now $1.50. But what's interesting for companies like HIVE, we've doubled and tripled our income. So we are financially much stronger. We gross $500,000 a day, even after this crypto correction. So I think what's really weird is for me is seeing that Hive trades at 4 times earnings. And so there's such a bear market. We've been living in a bear market actually for a year now. And we're off easily 70% from the high. So there's such a negative sentiment because the G20 finance ministers are all anti-crypto. And this debate is going on with decentralized versus centralized. So it's simple. If you don't believe in Bitcoin, then you don't believe in democracy. If you don't believe, just like the Chinese don't believe in Bitcoin, well, it's a communist country. There's no democracy. There's one political party. You're seeing this take place with many other. Brexit was about going decentralized from the EU. There's macro factors, just like Bitcoin is this decentralized asset class. The only other one is gold. It used to be cash, but you really can't move much cash. And when Ukraine was invaded by Russia, it wasn't gold bugs sending over gold. They couldn't send it. You couldn't wire. But the Bitcoin ecosystem was sending $500 at a time. And over a week, $60 million went over to try to help the Ukrainians. And now it's over $100 million. We saw with the truck strike in Canada, something like 5 million in small amounts of Bitcoin went up into crowdfunding to help all the truck drivers protest against the right to assembly, the right to protest. So I think it's really fascinating, this debate between centralized and decentralized, and the only 2 liquid assets globally which really are decentralized are gold and Bitcoin.
Yeah, so really interesting. And one of the things that I have been reading about this week is, the US dollar apparently it hit a 20-year high this past week. What do you make of that?
Well, it has to do with relative interest rates. So if you look at the negative rates that were in the EU versus Japan, as 2 big trading blocks around the world, and the US has the highest change in rates rising, even though they're way behind the CPI number. Volcker had to take interest rates to 20% to crack inflation. Inflation had run to 12%. So we had to go 600 basis points over. I think you'd have a global crisis of bigger than 2008, 2009 if you took interest rates at 20%. So I don't think we're going to have that at this stage. Because there's other systemic risks that the world is dealing with after COVID. One of the factors is what shocks me is the price of oil is $100 a barrel with China with a lockdown. If China didn't have 30 cities with a lockdown with a slowing purchase manufacturers index, then you could see oil at 150 a barrel because the supply lines are all very restricted. And then you have taxes like Trudeau's 25% carbon tax. That's really just a game to play. Climate change game for me is to take tax dollars away from workers. And all that's done is you're paying now over $8 for a gallon of gas. And that's not helping. So can you imagine if you had to go to $12 a gallon of gas? What happens to your Uber car drive? What happens to your taxi cab? So I don't have a car. Okay, well, take public transportation. All the prices have to go up. So that 25% hike in Canada will be very inflationary. And that's what people don't see. They just feel it in their pocket as they have less income now, but actually it's very inflationary. And so it creates these other risks. And that's where gold asset classes like gold. But I think the Gala Group really talk a lot about the gold manipulation by using futures market. People have been charged. It's been well documented, but they also, the concern is that they're also doing this with Bitcoin because Bitcoin has a futures price to it, but there's no margin allowed on a futures for Bitcoin. There is for gold, so you can get much bigger bang for your buck. So there is the thought process out there, but it only can last so long. China shuts down all Bitcoin mining. It has a short-term temporary. It's a global phenomenon like gold is. The rupee makes an all-time high. Well, Indian women wear 6 times the amount of gold that's in Fort Knox. Are they ever smart? So you have to think about this diversification and having a 10% weighting in gold and rebalancing each year and buying good quality gold stocks, which have free cash flow, and owning some Bitcoin, Ethereum, or Hive as your proxy. I'm speaking very biased when I talk about Hive, but I just know it's such a phenomenal, simple company, like a royalty company.
Yeah, so one of the things I wanted to ask you about is something that we've talked about before. We've talked about, during COVID, the influx of retail investors into the market. As your comments of today have really shown, there's a lot of turmoil out there. And I think that people are maybe now realizing that it doesn't just go up, things can go down as well. So do you think we're going to see these new people who got into the market leave? What would the consequences be there? What do you think?
I think that a lot of them came in were very clever speculators and traders. I don't think a lot. So you have different pockets of money. What I shared with you earlier in the cycle was that you need price discovery. If you do not have price discovery, institutional money cannot go into that asset class. So what we had with the COVID lockdown was all the Robin Hoods in particular, and smart young people like yourself that know capital markets, all of a sudden buying $500 of this and $1,000 of that. And in the US, a lot of people got their Trump $1,200 check, roll it right into the market or Bitcoin. And so they made money on that uptrade, and they took it out and bought a new TV. It's interesting to watch, but that price discovery brought in institutional money, and then all of a sudden it starts having its own growth. And that's what creates a robust bio ecosystem. So I don't think they're going to go away. I just think they pull back. I think they try to speculate on going short or buying puts. I think that they're very educated. This sort of new nucleus of crypto kids and speculators in stocks.
Yeah, so I think that one of the things that is also coming up as we hear about what's going on in the stock market, I've seen a lot of headlines about concerns about a recession. I want to get your thoughts and see if that is something that you think is coming either in 2022 or looking beyond. And we can talk about the US, but we can also look globally as well if you'd like.
Well, the big concern would be China for the commodities, because what you can see, Charlotte, is the more left a government is, the longer the lockdowns were during COVID. Let's compare New York State versus Florida. Let's take Miami versus New York City. Both have huge retired groups of people. Why was the death rate percentage of 1,000 people much greater in New York than Miami? Policies, government policies. So you can see these policies do have an impact on the flow of funds in capital markets. So China's putting a dent into commodity demand and the supply of finished products coming across. So that's why used cars have appreciated over 30%. And so I think this is a very different phenomena, because the severity right now of locking down, they've not embraced messenger RNA for vaccines. So therefore, they've had other outbreaks where we've not. And so how this big 55% of all commodity demand is China. So and Canada in particular, junior mining is so caught up with what they're doing. What'll happen is that when they open up their floodgates, it's going to be like every other thing. There's huge binge demand. It's binge. And what we're seeing right now with my Jets ETF, I'm going to change my hat to tell you about it, is higher oil prices because refineries that shut down during COVID, many of them didn't come back on stream. So the demand is still huge. So now you see the price of gas, in addition to the carbon tax at 25% in Canada, but you're seeing demand in the US, they're not caring. It doesn't matter right now because everyone's thinking next year we're going to get locked down again. So there's a binge holiday. So what are we seeing with the airlines is this concern they just higher oil prices, higher ticket prices. Doesn't matter. Hotels in Europe are $1,000 a night. 1,000. And if you want to go to the Four Seasons, $2,000 a night. And they're sold out. So there's something of this recession. It's how long will this binging take place? That's the thing I can't tell you, but I do know that the more left the country was, the more they've been anti-Bitcoin and crypto, and the more they've had severe lockdowns. And I was talking to the head of NASDAQ in Dubai, and they say that they're number one in the world of how they dealt with COVID as government policies and how they stayed open throughout everything and how other countries had these draconian measures. So you have to think of supplies restricted, then all of a sudden demand is restricted, and then it's unleashed. It creates big supply demand problems. But right now, Jets is trading up and down with the price of oil. The airlines think they're going to turn profitable, but there's a shortage of pilots because many of them turned 65, and they changed laws 7 years ago that they had to have that almost like 10,000 hour number, but it's not as severe, but they had to have more tacit knowledge experience. What that means is that you can get your driver's license, but that doesn't mean you're a good driver. So they want to have pilots that have the tacit driving capability in addition to having their license. So we have all these sort of unique disruptions taking place. And I think when China opens up, buy every commodity stock that has real reserves in the ground in a safe jurisdiction, because I think they just pop like we've never seen before. And so that led me, because seeing Jets and what's taking place, I launched my new Sea to Sky ETF. And I was frightened. I was frightened because it was coming out in January and the market was starting to unravel. And as the market unraveled and then Russia invaded Ukraine, it actually went up. What is it telling me? It's telling me that the supply lines around the world are going to remain very, very tight. And that means that the cargo jets and cargo ships, which carry 80% of all products around the world, have pricing power. And it looks like, in talking to all the management, it's a secular trend for the next 3 to 5 years. It's an inflationary hedge like gold, because they can raise the prices faster than inflation. And when Russia invades Ukraine, all of a sudden you can't fly over Ukraine, all of a sudden you have a different path. They pass all those prices on to you, need that product. And I know from being an executive chair of Hive and getting stuff coming from China, we have seen a 300 to 600% increase in the cost of shipping, and by air or by ship. So that's why I launched Sea to Sky. It's like the beautiful highway from Vancouver to Whistler, but it's about 70% are cargo ships, 30% are airlines. And what's interesting is that Air Canada is now coming out and converting their old airplanes into cargo. There's huge volume, there's huge opportunity for profits. Lufthansa Air has done the same thing, Cathay Pacific. So we are in a new world of disruptions of supply lines. But I wanted to bring back all your listeners to this theme of decentralized versus centralized. And decentralized is anti-globalization. And it's interesting that the definition of the left of how they're anti-globalization is different than the idea of being self-sufficient and protecting of jobs. No, it's just protecting even resources. So there is a global trend. And everyone became really upset with Russia going to Ukraine because that's centralization, that's expansion, that's taking over someone else. Not only the tragedy of killing innocent people, but it's going centralized. Brexit is decentralized. Bitcoin, Ethereum, they're decentralized. And it's just recognizing boutique hotels in America, getting away from the general Marriott hotel. That's going decentralized. And all of a sudden, there's greater value in a luxury small boutique than there is a big JW Marriott. And this is a real human being sort of theme that's happening around the world. And I think it's very exciting. And the big money will be able to see this disruption of how do you play this going decentralized.
Yes, and you've given us a lot of different avenues that people can pursue in these tricky markets right now. As we're finishing up, is there any final advice that you would leave investors with?
Yes, always be diversified. The golden rule is 10% gold and gold stocks and rebalance once a year. And now I throw in there, you should have 2 to 3% into crypto. But I also think that a simple thing, whatever your age is, you should be into shorter term income, not long-term income, but it's shorter term. So now rates are rising. My short-term bonds, I don't have any long-term bonds. I only have very short term for people that are in their 60s and 70s. And I find a lot of gold bugs are 50s, 60s, and 70s. So that area is that if you're 50 years old, 50% should be short-term income or special income, that like gold notes, like Grand Columbia has their gold notes that became Caldas. But they've taken over another gold note circulation. I love those pieces of paper because I get paid monthly and I get paid 7.25%. And I think otherwise you have to make sure you're short term and you have your other assets, so you always have this liquidity. If you're 75 years old, 75% should be in shorter term income. Now, being young like you, 25 years old, it should only be 25%, and 75% should be long the market and more speculative, because you can hold it longer and you can deal with the whipsaws. And if you make errors and mistakes, you can recover in the various cycles.
Okay, yeah, I always love the age trick there. So thank you so much for coming on to talk. I think we covered a lot of ground, definitely a lot of hats. Great to have you as always.
Well, stay optimistic. That's the opposite of most of the media out there.
We'll certainly try to do so. Once again, I'm Charlotte McLeod with the Investing News Network, and this is Frank Holmes with US Global Investors.